Hello, I'm Ed Parrott with Keller Williams. It's June 30th, 2024, so let's take a look at where the real estate market stands this week. For existing home sales, the latest figures we have are for May, and they fell again by 0.7% month over month to an annual rate of 4.11 million homes sold. This is a continued decline from the recent peak of 4.38 million in February. So we're projecting 4.2 million homes will sell in 2024, and while that's up from the 4.09 that sold in 2023, it's well down from the most recent peak of 6.2 million in 2021. Even as sales decline, prices continue to rise, although a little more slowly. The Case-Shiller Index is up 0.3% month over month and 4.4% year over year. So that's a little bit of good news. And as you can see from this chart, the long-term trend has been 4% appreciation. We did go above the trend line from 03 to 07, but the crash of 08 hit, and by 2011, prices had dropped to a median of 166,000, which is just below the 2002 level. Now this chart shows the ups and downs in appreciation since 1990, and on an annual basis, I'd personally like to see the appreciation drop to somewhere between 1 and 2% for the next 3 or 4 years. And that'd allow the market to drift back down to the normal trend line. And I do expect downward pressure on prices to continue. New home sales slumped in May, falling 11% month over month and 17% year over year to 619,000 homes on an annual basis. Also, pending home sales on existing homes suffered again, with NAR's latest sales index dropping 7.7% month over month in April and another 2.1% month over month in May to a level of 70.8. Now that being said, I'm not expecting a pullback in prices, and I'm certainly not expecting an 08 style crash. Last year we had a short-term pullback which lasted a couple of months, as I recall, but then it recovered and the upward trend in prices continued. If we have a more significant pullback, there's no need to panic, however, because unless we have a complete crash in the economy, things will improve. As an anecdote, and this is certainly nothing scientific, but I have a friend down in Florida that bought his house in 2007, just before the crash. He paid, as I recall, $825,000 in that ballpark, and after the crash hit, his home was suddenly worth $550,000. But he stayed the course, made his mortgage payments, and he's still in that same house today. And the last I spoke with him a few months ago, the current projected market value for his home is $1.3 million. So for that reason, if you look all the way back to 1900, the economy has had ups and downs all the way, and real estate has had a few ups and downs in that same period. But in the long term, things are going to be okay. So what more can I say? Now, the primary reason I'm not expecting a major pullback in prices is that right now it's still a seller's market, even with the slowdown in price increases and sales volume. Currently, there's an average of 2.8 offers on each home that sells, and that's down considerably now from the 5.5 that happened back in April of 2022, but it's still a strong number. In addition, 30% of the homes sold are still going for more than the asking price, and it's taking less than 30 days to sell roughly 67% of the homes. Two more items I find interesting are the number of first-time buyers and the number of cash sales. Currently, 31% of the homes are selling to first-time buyers, and that's a reflection of the events that are still happening in people's lives every day, and that keeps the demand strong. And those things include graduating college, getting married, having children, and all too frequently divorce. An additional factor is death, which may leave a widow wanting to downsize, resulting in a sale and perhaps a purchase. Or if there's no widow, or the widow herself passes, then obviously the heirs will sell the house. Now, on the subject of cash buyers, those are consisting mainly of older homeowners and also investors. As mortgage rates go up, cash buyers have made up an increasing share of sales. Currently standing at 28% as of May 2024, it's increased steadily since 2022. Moving on to mortgage rates, for the second week, the 30-year fixed rate ended around 7.0%. Now this is up just a tick from a year ago, and it's about a point below the recent high in October. Now, a big influence on the mortgage rate is inflation, because that's one of the factors driving the target rate range for the Federal Reserve. Thankfully, it's continuing a slow decline. As you can see from this graph, the so-called headline inflation is currently at 3.25% for May, while the so-called core inflation is at 3.41%. And as you can see from the chart, that's down considerably from the recent peak back in June of 2022. At that point, the headline inflation was 8.98%, or might as well call it 9%, and the core inflation was 5.9%. And core inflation did peak up there just a little bit. It got to 6.64%, but then they both continued their downward trend, and that's where we're standing now. And hopefully they will continue to trend downward. Now, just to recap, headline inflation includes all items in the economy, while core inflation excludes food and energy prices. And the reason they do that is food and energy are much more volatile than the rest of the economy, and the Fed is trying to control inflation with their monetary policy, and they don't really feel that they can control food and energy that well, so they discount those and concentrate on the core inflation, trying to get it down to the 2.0% target rate. So that's why Fed Chairman Jerome Powell and a majority of the rest of the Federal Open Markets Committee have maintained their tight monetary policy of selling off their securities and also keeping the target rate range high for so long. They are determined to reach their goal of 2.0% core inflation. Now, I will point out that it was at pretty much 2.0%, around that range, up until January of 2021. Now, at that point, inflation started a rapid upward climb, and as a result, the Fed raised the target range 425 basis points during 2022, and another 100 basis points in 2023. Along with other factors, that put upward pressure on the 30-year fixed rate, and up it went. So the increase in the 30-year mortgage rate, along with some other factors, resulted in the rapid appreciation of home prices, and that's why we're in the mess we're in right now. So I'll need to do another video giving my thoughts on the factors that did in fact cause the rapid increase in home prices over the last couple of years. Now, the fact that the FOMC held the target rate steady during their last meeting on the 12th is a good sign, and this is the 7th consecutive meeting that they've held the target range steady, so most everyone expects a rate cut before the end of the year. Now, personally, I rely on the Chicago Mercantile Exchange for my Fed forecast because, as I've said in the past, they have both a bigger computer and bigger brains than I do. But looking at their forecast for the remaining meetings of this year, there's a good outlook for a reduction in the target range, but it'll probably just be the one reduction. The CME is predicting only a 10% chance of a cut during the July meeting, with a 64% chance during the September meeting. I don't think there's going to be a cut in July, but we'll see. By the November meeting, they're giving even odds of at least a 25 basis point reduction, and they're predicting about a 63% chance of a reduction of at least 50 basis points by the December 18th final meeting of the year. That'd be nice. And while I'll welcome any reduction, I will point out that back in January, most everybody, including me, was more optimistic on the inflation front, and pretty much everybody was expecting up to 3 rate cuts this year. Clearly, that ain't going to happen. So I'll close out with a quote from Lawrence Yun, the NAR's chief economist. He says, "The first half of the year did not meet expectations regarding home sales, but exceeded expectations related to home prices. In the second half of 2024, look for moderately lower mortgage rates, higher home sales, and stabilizing home prices." So that wraps it up for today. Thanks for watching, and I hope to see you next time.